Hello students, welcome to my class. This is Professor Vincent Usaya, and this is part 3 of chapter 11 presentation, current liabilities and payroll. So we did talk about deductions from gross pay and how to calculate net pay in the last part of our presentation. Here we are talking about optional withholding deductions. So these are deductions from payroll that are optional. Like we indicated earlier, you can go to your payroll department and instruct them to deduct $50 from your paycheck every month for Salvation Army or Red Cross, so on and so forth. So here are some samples of optional deductions: pension contributions, insurance premiums, charities, so on and so forth. The most important thing that I want you to know here, or the second important thing that I want you to know here, is these deductions from your company standpoint are obligations or liabilities. They are usually current liabilities because those withholdings are usually sent to different respective parties, definitely within a year, definitely usually in a month or less than a month. So that is why they are important as far as the discussion of this chapter is concerned. Don't forget that the topic of this chapter is what? Current liabilities and payroll. So moving along, let's take a look at how we record or account for payroll. So take a look at the situation we have here. Let's assume that our gross pay for all the employees is $28,580. Look at what happened. We withheld from all the employees OASDI, Medicare, income tax, so on and so forth. Our total withholding is 7796. So the difference between our total withholdings and gross pay is $20,000. So that is the employees take home. So now, how do we make the journal entry? Let's take a look at what happened. So we debit salaries and wages expense for $28,580. So watch out for this. Remember I told you that even though you are not taking home your gross, technically the employer or your company actually pay you everything. The withholdings are due to the government asking your company to withhold some of your money and send it to them. So the take home here is $20,784. The gross is $28,000. So your company is taking full credit for the total gross because that is what the company actually coughed out in this payroll. But let's take a look at all the other credits. These are all liabilities. So the money that we withhold from the employees on behalf of the government and on behalf of other parties are current liabilities. So we recognize them as current liabilities, and they will remain current liabilities until we actually cut the check to the government or to other parties. Then we debit the payables and we credit the cash. Now, let's take a look at another important thing about payroll that a lot of people are not aware of. The entry that we just talked about was the entry to record salaries and wages paid to the employees. Then guess what? The company also have another type of special obligations relative to payroll. What is that? Listen to this carefully. Just like you have your rent expense, telephone expense, property tax, so on and so forth. Anytime a company has a payroll, the government asks the company to pay a special type of tax, and we call that payroll tax expense. If you don't have payroll, then you don't have to worry about paying payroll tax expense. So this is another tax that the government sticks employees with. Now, how do we calculate the payroll tax expense? Take a look at this. The government asks the company to match your social security tax dollar for dollar. So if you pay $20 in your if you pay $20 as an employee, the company is obligated to pay another $20 on your behalf, and that $20 is credited to your social security account. By the time you get to social security age, you get the full benefit of it. So here, the company is going to pay 7.65% of earnings up to $110,000. The figure that we are using here is for 2012. So the rate for the company and the rate for the employee is different this year, 2012, because that is when this textbook was published, or this edition was published. So, but nevertheless, 1.45% you paid in all earnings, all right, like we discussed earlier. Then, so that is the FICA or Social Security part. Take a look at number 2. The state and federal unemployment compensation tax is another type of tax that the government stick to employees. Now, it is important for you to know this. You and I, as employee, we are not obligated to pay state and federal unemployment tax. It is only the company that pays unemployment tax. What is the spirit of unemployment tax? It's more or less like an insurance, just like your auto insurance. If you have a car, you pay auto insurance. If you have an accident, you claim. So every company that has an employee is obligated to pay federal and state unemployment tax, because when they fire their employee go to the government and collect their unemployment check. So again, only the company is obligated to pay this, not you and I as employee. So add all of this together, that is what we call employer payroll tax expense, additional expense of doing business. So take a look at the payroll tax, additional issues. So it's 5.6% in the state, 0.6% in the federal government. It depends on the state, and it depends on the industry in which you are working in. Just like some of us pay more in our insurance, in our auto insurance premium, some companies pay more in their unemployment insurance contribution. Why? Because some companies fire employees more than the others. So moving along, let's take a look at how we will record payroll tax expense. This is the company's obligations related to payroll. Like I said, look at the title, payroll tax expense. If you don't have payroll, you don't have payroll tax expense. So with debit payroll tax expense for 2081, look at the composition or the components of payroll tax expense. Number 1, FICA, the OASDI part of FICA, Medicare part of FICA, federal unemployment, state of unemployment, add all them together, that will give you payroll tax expense. So moving along, here we have some internal controls for payroll. What are we talking about here? We don't want a situation whereby we have a ghost payroll. So we need to make sure that we are actually making payroll payment to authentic, legitimate employees. So here are some of the controls that we put in place. For example, employee has to sign for checks and present their ID before they collect their payroll check, so on and so forth. Now, let's take a look at objective 3, how to account for current liabilities that must be estimated. Remember at the beginning of the chapter we said that current liabilities can be further divided into 2 categories. We have current liabilities whose amount are known. In other words, you know exactly how much you owe. Then you have some liabilities that has to be estimated. Why do they have to be estimated? Because you really don't know how much you owe, but you know that you owe something, so therefore we have to estimate it. So that is what we are going to talk about here. So one example of that, here are some of the examples of estimated liabilities: bonus accrued, vacation and sick leave, pension expense, warranties expense. We are going to zero in, and I'm just going to give you the example of the last one, which is warranty expense. Why do we have to come up with an estimate? The key is we need to be in compliance with the matching principle. Remember the matching principle that said we have to match every expense with the revenue that they produce? So let's look at the last one. Assuming that you produce, you are a manufacturer of television, and you produce or manufacture 1,000 television this particular year, and you have a warranty on them. Warranty, or meaning the TV are supposed to work the way they are supposed to work for at least 1 year. So at the end of the year, you really don't know how many of those TVs that they are going to return. However, you know that it is inevitable that some of them are going to be returned for repairs or for replacement. So at the end of the year, you have to come up with an estimate of X amount of dollars. You have to make provision for X amount of dollars of replacement or repairs in the future, so that you can recognize warranty expense for that particular year. So that is what we are doing here. So let's take a look at this example. This company guarantees that the vacuum will actually work for 4 years. But they also know that past experience tells them that 6% of sales, approximately 6% of sales will result in warranty cost. That is either replacement or repair. So take a look at what they did in that year. So 6% of $200,000, which is their sales, result in 12,000. So the debit warranty expense for 12,000 and the credit warranty payable for 12,000. Now take a look at this. Here is the main focus in this chapter. The key is what? Warranty payable. It is a liability. Remember, in this chapter, the title is what? Current liabilities and payroll. So we have recognized the liability accordingly. Now, objective 4. Let's take a look at how to account for or record contingent liabilities. This is another type of liabilities. What is contingent liabilities? These are liabilities that are contingent upon the happening of something or something not happening. What do I mean by that? Let's assume that one of our truck drivers, if we have a trucking company, had an accident. And of course, what do you expect? The people that were impacted sue our company in November. Now, in December, we really don't know whether we are going to lose the case or win the case, but in December, we need to make provision for X amount of dollars that might result from our exposure. So that liability is contingent upon the outcome of the case in court or the litigation. So that is what we are talking about here. So let's take a look at what we have here. We say that the contingent liability is a potential liability that depends on a future event. So how do we account for contingent liability? We really don't know yet what's going to happen in the future, but do we account for it? Yes and no. And how we do that, we are going to discuss that in part 4 and the last part of chapter 11 presentation.